Okay, well, so thank you all again for joining us in another Ebury webinar, this time focusing on the Turkish lira. So without further delays, I will now welcome Matthew Ryan, a Senior Market Analyst at Ebury. Welcome, Matthew.
Yes, thank you very much, Lizis, and thank you all for joining. Welcome to our webinar today on the Turkish lira. I hope you find it informative and enjoyable as well. Very quick introduction before we get going. So my name is Matthew Ryan, I'm Senior Market Analyst here at Ebury. I've been at the company around about 6.5 years now, based in our London office in the UK and our headquarters. As part of our strategy team, we produce a range of material reports, analysis on a host of major G10 currencies, but also emerging market ones as well, including, of course, the Turkish lira. And that's going to be that's going to be the topic of the next hour or so. I'll be talking for probably the first 30 minutes or so, giving a general update on the lira, the current situation in Turkey, whether that be COVID, how the Turkish economy is performing, and giving our sort of general views on what's driving the Turkish lira at the moment and our expectations in the short and longer term as well. I'll then hand over to Noyan Serim, who's one of our business analysts. He's going to be talking a little bit more about the practical side of dealing with the Turkish lira, sort of paying in lira, and I believe he's going to give a few case studies as well, as to some companies have done just that. We'll then have time at the end for a few questions. If you do have any questions, there is a Q&A function on the Zoom app, which you should be able to see on your screens. So if you do have any questions as we go through the presentation, please feel free to type it in this Q&A box, and we'll get around to answering those once we're both done at the end of the presentation. So I think we'll get going. I'm just going to, there we go. We're going to talk about the structure of this first sort of half an hour or so of the presentation. I'm going to start by talking about the COVID situation in Turkey, the latest case numbers, the latest vaccination numbers, and what kind of impact they're having on the lira. Then going to talk about how the Turkish economy has performed since the beginning of the pandemic. Touch on monetary policy as well. Recent decision-making at the Turkey Central Bank has had a significant impact on volatility in the lira. We're going to talk about that. I'll then move on and talk about Turkey's macroeconomic fundamentals, how we believe that Turkey's fundamentals are among the weakest of all the emerging market currencies that we cover. I'm then going to sort of wrap everything up and bring everything together at the end and just summarize the main factors that we think are driving the lira at the moment, and what we think is next for the currency, or what are our expectations in the sort of short and longer term. So I'm going to start, as I mentioned, with the current COVID situation in Turkey, which of course has swept around the world in the last sort of 12 or 13 months or so, and we've seen a deterioration, a pretty rapid deterioration in the COVID situation in Turkey in the last few weeks. Case numbers have increased pretty significantly since sort of late February, early March time, as you can see chart on the top right-hand side. Case numbers are now in excess of the 60,000 per day level, which is considerably higher than where they were during the first and second wave of the virus, around about double the second peak from December, obviously considerably higher than the initial peak, that largely due to relatively limited levels of testing at the beginning of the pandemic. Of course, a lot of this is due to the new variants, particularly the variant that was first detected in Kent in the UK at the end of last year, which is said to be up to as much as 70% more transmissible than the original strain of the virus. And that currently accounts for around about 85% of new cases. Unsurprisingly, unfortunately, we've seen an increase in new COVID deaths in Turkey as well, as you can see in the chart on the bottom right-hand side. Now around about the 350 per day level, which is considerably higher than certainly the first peak and also the second wave of the virus. So unsurprisingly, we've seen a tightening in restrictions in Turkey. Actually, if we look at during the entire pandemic period, restrictions put in place in Turkey haven't been quite as strict or severe as we've seen in many other major nations and a lot of Turkey's peers. But we have seen a tightening of restrictions in the past few weeks, particularly in the last few days. As of today, a national lockdown has been put in place in Turkey. It's actually the first national lockdown that we've seen since the beginning of the pandemic. Restrictions so far have been largely regional, but a national lockdown has been deemed necessary in order to rein in rising levels of infection. Partly, we think, as well, to protect the Turkish economy from the very important tourism season, which of course is coming up over the summer. Tourism is very important to the Turkish economy, makes up a much higher percentage of GDP in Turkey than many other major nations, and certainly a lot of Turkey's peers. So these measures put in place may partly be in order to alleviate pressure on Turkey's tourism sector. Actually, if we look at overall cases since the beginning of the pandemic, as a percentage of the population, it hasn't been quite as bad on paper in Turkey as we would see in a lot of other major nations. The cases per capita ratio of 55,000 per 1 million is considerably lower than, say, the US, for instance, which is around 100,000. And the death ratio as well, 455 per 1 million, again, considerably lower than, say, in the US, which is around about 1,800 per 1 million, or the UK, which is around 1,900. Partly, we think that's due to slightly less testing in Turkey, but also partly a consequence of underreporting of both cases and deaths. Asymptomatic cases, for instance, have not been included in a lot of these tallies. So actually, in reality, we think the situation has been slightly worse in Turkey than it appears on paper, certainly during this latest wave of infection. On a more positive note, we are seeing Turkey making steady progress towards mass vaccinations. So far, around 25 doses of vaccines have been administered per 100 people in Turkey, which if we compare that to a lot of other emerging market countries, it is significantly better. It looks at the likes of Brazil, China, as you can see on the chart, Russia, for instance, India. Turkey's doing much better than all of its emerging market peers. As a percentage of the population, around 16% have received one dose, and another 10% are now fully vaccinated, have seen both doses of vaccines against COVID-19. It's actually slightly slower than the EU, but not by a huge amount. The EU has vaccinated just over, or administered just over 30 doses per 100. And actually, if we compare Turkey to the world average, it's doing considerably better. You can see on the chart there, the world average is around about 13 doses per 100. So around about double that has been administered in Turkey on a per capita basis, which is certainly very encouraging. One of the main reasons we think why we have seen a much faster pace of vaccinations in Turkey is the use of this Sinovac vaccine, the Chinese-produced vaccine, which has sped up the pace of vaccinations. It's a vaccine that's not been used, say, in the EU, for instance, that relied much more heavily on the Pfizer vaccine, and of course the AstraZeneca vaccine, which has run into a number of problems in the past few months, a lack of supply being one of them, and a number of safety concerns surrounding potential blood clots. So that has helped speed up the pace of vaccination somewhat in Turkey. The issue that we think Turkey may potentially run into using this Sinovac vaccine is the slightly lower efficacy that the vaccine appears to be showing relative to some of its peers, notably like the Pfizer or Moderna vaccine, for instance. There's been a number of trials that have had varying levels of efficacy and effectiveness against preventing transmission and serious illness. The early ones, the initial one, of course, I think it was around about a little over 50% efficacy level, which is considerably less than some of the other vaccines. So we do think it will need to, Turkey will need to vaccinate a greater percentage of its population using this vaccine in order to get enough immunity within the population before it's able to unwind restrictions without incurring an increase in fatality. So that does present a bit of a downside risk to the Turkish economy and the lira as well. But the government still aims to vaccinate all of its population, or the majority, I should say, of its population by the end of June. We're optimistic that they will do, and we're equally optimistic that we'll see some sort of sense of normalcy in the second half of 2021, which it could potentially be good news, or should be good news for the Turkish economy. A concern that we do have is this slowdown or an easing in the pace of vaccinations, as you can see from this chart. So this represents the number of daily vaccinations against COVID, number of daily doses per 100 people. You can see Turkey, and there's a red line against the European Union and the US. You can see that, well, actually pretty much every other nation, most nations have seen a gradual increase in the pace of vaccinations since the beginning of the vaccination drives. Turkey, however, is stalled slightly. We've seen a bit of a plateauing and easing in the pace of vaccinations. But we are optimistic that we could see an uptick and an acceleration in the next few months. Pfizer is expected to increase its supply to Turkey. Russia's Sputnik V vaccine is also due to be produced in Turkey in the next few weeks. Turkey is also looking to sign a deal with Moderna as well, which should certainly help in this regard. So there's plenty of reasons to be optimistic, and we're hopeful that we will see an acceleration in the pace of vaccinations in Turkey in the coming 2 or 3 months or so. As mentioned, though, we have seen a tightening in virus restrictions in Turkey in the last few weeks. Actually, if we look at during the entire pandemic period, restrictions have not been quite as severe in Turkey as many other of its peers, and certainly many of the major nations. Restrictions have been largely regional. There's been no full national lockdown imposed up until, well, as of today. I believe it was maybe 1 or 2 hours ago when it came into force. So that has allowed the Turkish economy to outperform a lot of its peers, and actually Turkey was one of the few economies to grow, experiencing expansion in 2020, as we'll get to in a few slides' time. But as I mentioned earlier, we have seen a reimposition or imposition of some tougher measures in the last few weeks due to this surge in cases and deaths that we've seen in Turkey as a result of the virus. Unfortunately, Turkey doesn't seem to have vaccinated enough of its population. Unlike, say, the US or the UK, not vaccinated enough of its population to unwind measures without incurring an increase in both cases and deaths. Hence why we're seeing these tougher restrictions put in place, including the full national lockdown that has been enforced as of today. And I believe it's set to run until, I think it's the 17th of May, although let's see how it goes. That may well be extended beyond that date. This chart, just to explain this chart, is a good representation of the current situation regarding restrictions. This is the COVID-19 Government Response Stringency Index, courtesy of Oxford University. Obviously, the higher the index, the tougher the restrictions, the lower the number, the looser the restrictions are in place. You can see Turkey, throughout most of the pandemic, has had slightly less strict restrictions than, say, the US. Actually, this maybe is not the best representation of restrictions, given that it takes the most strict restrictions in place across the whole country. So for somewhere like Turkey, that's imposed regional lockdowns and is quite a large nation, is actually perhaps not the best representation of that. But we can see in the last couple of months or so, you can see that divergence whereby Turkey is beginning to tighten its restrictions. Nations, particularly the US, for instance, the UK, have been able to ease lockdown measures. So that does present, we believe, a little bit of a downside risk to the Turkish economy in the next couple of months or so. And that leads us quite nicely onto the next section, which is all about the Turkish economy, how it's performing since the beginning of the pandemic. As was the case everywhere, really, the Turkish economy collapsed, really, in the second quarter of last year. GDP fell by 11% in Q2 2020, quarter on quarter. Slightly better than expected, actually. The downturn was not quite as severe as some analysts had penciled in, but it was still the largest on record. Actually, not quite as bad as many other nations, a lot of its peers. We look at India, for instance, contracted by 25%, I believe. Mexico was around about 17%. So actually, these less strict measures put in place meant that the downturn wasn't quite as bad in Turkey as many other nations. And actually, it's been one of the reasons why we've seen such a significant rebound in Turkey. So certainly the second half of last year, we had growth of almost 16% quarter on quarter in Q3, and growth again of 1.7% in Q4. And actually, if we look on a year-on-year basis, annual growth was nearly 6%, or around about 6% in Q3 and Q4. So that's 6% growth on the year previous, which is quite astonishing, really, given the shutdowns, and significantly higher than most of Turkey's peers. A lot of countries experienced negative year-on-year growth. In fact, most did in the second half of last year. A lack of external demand due to the pandemic does present a bit of a risk to the outlook and has weighed on activity in the last few months, but it's been mostly or comfortably made up but by a sharp increase in domestic consumption, which we expect to continue to fuel growth in the next few months. And actually, Turkey was one of the few nations to post growth in 2020, as I mentioned, posting growth of 1.8%. I believe Turkey and China were the only two sort of major nations to post growth in 2020. Again, in large part due to the slightly less strict virus restriction measures in place in Turkey. Data out that we've had so far in 2021 has been a little bit mixed. We've seen some encouraging signs out of manufacturing, industrial production. Look at the manufacturing PMI, for instance, which is a index of business confidence and business activity in the manufacturing sector. That's been coming above the level of 50 in every month since May. Level of 50, that represents flat growth. Any number above is expansion month on month. Any number below 50 is contraction on the month previous. So it's continued to comfortably come in expansionary territory. Industrial production has grown each of the past 10 months. Business confidence is also high, so it's highest level in 3 years in April, which suggests that there's reasons to be optimistic about the near-term outlook. But on the other hand, there are a number of challenges that remain. There's risks to consumer spending being one of them. There's a number of unknowns, of course, the first of them being the third wave of infection that we're currently seeing in Turkey at the moment. And that's very much dependent on authorities' ability to rein in infection. Also, the vaccine rollout is going to have a significant impact on consumer spending, not just the pace of vaccinations in the coming weeks, but also the effectiveness of vaccines in suppressing rates of infection and allowing the economy to open up. But having said that, we are generally optimistic. We are hopeful that we'll see a solid rebound in Turkey, certainly in the second half of this year. And analysts and the general consensus is penciling in growth of around about 5% in 2021. I'm going to move on now and talk about something that's had a significant impact on the lira, to say the least, in the last few years, actually, and that's monetary policy in Turkey. And one of the main factors that has driven volatility and the sell-off in the Turkish lira in the past few months has been this unorthodox monetary policy stance that we've seen from the Central Bank of Turkey, particularly the big influence that President Erdogan has had on monetary policy. This is something that investors don't particularly like. They like the central bank to be independent of politics and policymakers. And when there's interference with central bank decision making, that's generally seen as a negative for investors. It usually causes them to sell the domestic currency, which is what we've seen with the Turkish lira. Erdogan has long opposed higher interest rates, and actually his sort of views on interest rates has defied the basic economic principles. Central banks will target an inflation level. Major central banks, that'll be 2%, for instance. Emerging market in countries, it will be slightly higher, but they'll set this inflation level. Whenever inflation drops below that target, that's generally an indication that they'll start cutting interest rates, trying to spur spending, and drive prices up back to that target. Whenever inflation is too high, above target, they'll raise interest rates. That lowers levels of spending. It drives down prices back to that target level. Erdogan has the opposite view. He's described higher interest rates as evil, believes they cause inflation, and he's pressured the central bank to keep interest rates artificially low, even when inflation has been spiraling out of control into double digits, as we can see from the chart. What's that done? It's kind of had the opposite impact as was desired. We've seen persistently high inflation, as you can see from the chart. It's been in double digits throughout most of the past few years. And also it's deterred foreign investors. As I said, investors don't like interference from politicians in the central bank, and also they're looking for higher yield. They're looking for countries that are raising interest rates, that have high carry, high real yields, and Turkey has been reluctant to raise interest rates, and that's deterred investors, which in turn has weakened the lira and pushed inflation even higher. So it's become a little bit of an ongoing spiral where we've seen both higher inflation in Turkey and a weaker lira. But what has actually gone on at the Central Bank of Turkey? Well, it's been a rather tumultuous few months, to say the least. The previous president of the central bank was removed by Erdogan back in November of 2020. And Erdogan handpicked his replacement, Nasir Akbal. And that was actually greeted very well by investors and the investment community. They were encouraged by what they thought was a return to more conventional monetary policy, whereby the central bank would raise interest rates in order to rein in higher inflation. And we saw a sharp recovery rally in the lira, both on the news of Akbal's appointment, and then in the few months following that, when interest rates were raised. As you can see on the chart, rates were raised. There was the main interest rate, which is the 1 week repo rate. That was raised by almost 11% between October and March to 19%, which led to a pretty sharp rebound in the Turkish lira against pretty much every currency. But we had another U-turn from Erdogan in March, just a matter of days after the March interest rate hike. Akbar was removed as president by Erdogan, and that triggered one of the most violent moves we've seen in the lira, and indeed pretty much any currency in the world in the past few months, certainly since the beginning of the outbreak of the pandemic. The lira fell by around about 15% in the immediate aftermath of this decision against the US dollar. And it's spurred concerns among investors that the central bank would be moving towards rate cuts again rather than additional hikes. And that's something that Erdogan has continued to note, his determination since then to lower interest rates despite rising inflation. We've actually seen the current president echo those views. And now many analysts are expecting cuts in the main interest rate at some point in the next few months, possibly towards the end of the second quarter, which, as we'll get to, is weighing pretty considerably on the Turkish lira. On top of the uncertainty created by central bank policy, the lira has also come under a bit of pressure from Turkey's macroeconomic fundamentals, which we believe, as I said at the beginning, we believe are among the weakest of all the emerging market currencies that we cover. And one of the main reasons why we've seen the lira sell off to the extent that it has done in the last few months and indeed the last few years. Another three main fundamentals we look at when doing our analysis of emerging market currencies. And I've listed them out here. The first of them being the current account, which is denoted as a percentage of GDP. Whenever the current account, which is largely made out of the balance of trade, so whenever that is in positive territory or in surplus, that's generally appealing to foreign investors. Whenever it's negative, the current account is in deficit, that deters investors on the whole. This deficit needs to be financed by capital inflows. When those capital inflows are insufficient, i.e. during a pandemic period, for instance, that's when we see investors ditch the currency en masse, and we can see some pretty aggressive moves in currencies that, or currencies of countries that have very large current account deficits. The second would be FX reserves. So this we look at in terms of months worth of import cover. Whenever reserves are high, that allows the central bank to intervene into the FX market in order to protect the currency from any unwanted sell-off. Whenever reserves relative to months worth of import cover, whenever they're too low, that limits the ability of the central bank to intervene in the market and protect the currency. So it's generally a sign to investors that the currency could continue to sell off. The last of them is external debt. And again, as a percentage of GDP, whenever debt is higher relative to GDP, that's generally seen as more worrisome for investors, increases the risk of default, and generally is a sort of a warning sign for investors to sell that currency and steer clear of that currency. And as we'll see from the next slide, we think that Turkey sort of fares pretty poorly in all three of these fundamentals. Current account is relatively large, current account deficit, I should say, of 5% of GDP. Now, one of the biggest issues for Turkey's economy, we believe, is Turkey's reliance and over-reliance on external foreign debt. Now, increasing levels of debt and borrowing from abroad, it can increase spending, which is great, and that's fueled Turkey's growth model. And Turkey's economy has grown by in excess of 5% throughout much of the past decade, fueled largely by external borrowing. The issue here is that it leads to a large current account deficit. Imports become much greater than the level of exports, leads to a large current account deficit, which exacerbates and has exacerbated moves in the lira during periods of risk-off sentiment in the market, which is what we've seen since the beginning of the COVID pandemic, of course, throughout much of the past sort of 12 months or so. And that's partly been behind the underperformance in the lira in the past sort of year or so. Reserves are also low, around about 3 months worth of import cover, so there's very little room for the central bank to intervene in the market and protect the lira. And external debt is also high at 58% of GDP. And concerning is the amount of this that's made up in foreign currency. Over half of that is denominated in foreign currency. What that means is whenever the lira depreciates, the relative value of this debt increases. And it becomes a little bit of a chicken and egg situation whereby the high levels of external debt fuels a weak sell-off in the lira, and the sell-off in the lira makes this external debt that bit more expensive to pay back. It becomes more of an issue with the weaker currency. So it does cause this problem to sort of spiral out of control, and that's what we've seen certainly in the last few years in this period of a weaker Turkish lira. And so that leads us nicely onto the lira itself, and we can sort of tie all these factors together and sort of outline what we've talked about in the last few slides as to why we think that the lira has sold off to the extent that it has done. And you can see the lira has been one of the worst performers in the emerging market universe since the beginning of the pandemic period. Actually, if we look at since the beginning of last year, the lira has fallen by around about 30% against the dollar, similar amount against the euro, and even since the beginning of 2021, down around about 10% against the dollar, 8.5% against the euro. And it's been not just the worst performer out of all the emerging market currencies since the beginning of last year, but also, as you can see here, the worst performer against the dollar since the beginning of this year as well. The currency did fall to its weakest position on record, I believe it's late October, early November time, around about 8.5 to the dollar. That was following the insistence of Erdogan. There was continued to call for lower interest rates, which, as I said, we've mentioned, the investment community didn't receive particularly well. It did rebound, as you can see, in the sort of 4 or 5 months or so following this record low. It actually rallied to its strongest position against the US dollar since early August, in sort of mid-February time, below 7 to the dollar. that was following this pretty dramatic U-turn and shift towards a more conventional monetary policy stance, whereby the central bank was raising interest rates very aggressively, in fact, in order to combat high inflation and protect the lira. And we did see that very strong rebound in the lira, in line with the rebound that we saw generally among risk assets. But as we can see, since sort of late February time, the currency has come under pressure again. We think partly a result of the worsening pandemic situation in Turkey, which we spoke about, but also driven more predominantly by this, again, a shift in policy stance by the Central Bank of Turkey, which after hiking interest rates aggressively, now looks like it's preferring cuts again. And we could get a series of interest rate cuts from the central bank in the next few months or so. Certainly, we think perhaps before the end of the second quarter, maybe early in the third quarter. So what has driven this start off? Well, I'm not going to talk about this slide in too much detail. It sort of just outlines everything that we've already talked about, but it's good to bring it all together onto one slide. So there's four main reasons, which again, we've talked about all these already. So the Central Bank of Turkey's very unorthodox policy approach, particularly President Erdogan's growing influence on central bank policy, which, as I said, investors have not greeted too kindly. Turkey has very weak fundamentals, in our opinion, and among the weakest of all the emerging market currencies we cover. Very large current account deficit, very low FX reserves that allow very little room for the central bank to protect the currency from any unwanted sell-off. External debt is high, and a lot of this is denominated in foreign currency, which, as I mentioned, whenever the lira depreciates, the level of this debt goes up in relative terms. It makes the situation that bit worse. Inflation in Turkey is also high, in excess of 10%. Generally, countries that have high inflation will experience a depreciation in their currency over time, over a longer period of time, as the relative value of their currency actually decreases. And also, more recently, as I said at the beginning, we've had this third wave of infection in Turkey as well. We've seen rising case numbers and increases in deaths, and this lockdown that has been enforced as of today. And all of these factors have weighed on the lira and caused it to be one of the worst performers in the EM universe in the past few months. So very quickly, before I hand over to Noyan, we'll talk about what's next for the lira. Well, the lira is one of the most difficult currencies, we think, to forecast. There's a lot of unknowns, a lot of uncertainties. The situation seems to change on a sort of weekly basis. Actually, we're pretty bullish on emerging market currencies. We think that most will rebound against the US dollar, particularly in the second half of the year. Our rationale for that, the global vaccine rollout is going well. We're optimistic that we'll see a significant unwinding of restrictions, particularly in the major nations, in the next few months. We're already seeing that in the US, for instance. That, we think, should improve risk sentiment and be bad news for the safe havens, such as the dollar, good news for risk assets, including emerging markets. There are a few exceptions to this, in our view. The Turkish lira, unfortunately, being one of those. We still remain pretty bearish on the lira. We think that it could well force a fresh record lows against the US dollar in the next few months, certainly. There's a number of factors as to why that's the case. We've talked about these, the external imbalances, this large current account deficit, which we don't think is going to go away anytime soon. This shift again from the Central Bank of Turkey towards interest rate cuts, and the high levels of external debt. These are the three probably the main issues we think with the Turkish lira, particularly high levels of debt. Once we start seeing interest rates around the world increase, that obviously increases the burden on this debt, and it's going to become an increasing problem for Turkey and for the lira, we believe, once certainly major central banks start raising rates, which are not there quite yet, but perhaps towards the latter stages of next year, that'll certainly become a bit of an issue. Real interest rates, as I said there, in Turkey are positive, so that could offset some of this, but we still think that the lira is probably in a position to continue underperforming a lot of its peers in the next few months and over our longer term forecast horizon. As you can see from the chart on the right, this represents the lira versus the JP Morgan EM currency index. You can see that the lira has considerably underperformed in the last few months against emerging market currencies. We think that that's probably going to continue, certainly over our forecast horizon in the next sort of 12 to 18 months or so. And with that, I'm going to hand over to Noyan, who's going to talk a little bit more about the practical sides of dealing with the Turkish lira.
Thank you, Matt. Let me just cast my screen. Present. Right, I'm hoping that everyone can see the presentation. Thank you again for joining. Thank you from my side. Once again, my name is Noyan Serim. I've been working at Ebury for just over 5 years now. I joined actually in the London office where Matt is based as well, but currently I'm based in our Düsseldorf office in Germany. And I work as a business analyst, and also I'm part of the Turkey initiative of Ebury. So we will be covering the benefits of Turkish lira payments today. So that's going to be the first thing we look at. We will then move on to a case study of a textiles importer based in the Netherlands. We will then move on to a rather unique solution of Ebury's, the parallel forward. And finally, we will close off with a further case study of a medical equipment importer out of Portugal. So, the benefits of Turkish lira payments, first of all, from the importer side or the buyer side. We will then also look at the exporter / supplier side momentarily. So first off, it reduces your currency risk even when you make payments in euros. So when you pay your suppliers in euros, you might think that there is no currency risk. However, suppliers based in Turkey, more often than not, are going to have costs in Turkish lira. These can be wages, other overheads, or production costs. So when the Turkish lira goes up in value, it strengthens, which means that euro Turkish lira goes down. Prices in Turkey, such as production costs, can actually increase. And in order to compensate for this loss, the price of goods may actually be increased. This is what we call indirect currency risk. So secondly, it reduces costs for suppliers when you pay in Turkish lira. So your supplier will have conversion costs due to the aforementioned details such as wages or other overheads. And it is not standard practice in Turkey to actually hedge. Now, there can be a number of reasons for this, but for the purpose of this presentation, we will focus on two. The first one being that some banks may not offer the product to all clients. And the second one being that companies or people may actually not know about hedging strategies. So currency fluctuations actually can lead to suppliers adjusting the pricing if the rate of exchange moves against them. And obviously, this in turn would affect the buyer's profit margins, as they would have to pay more for their products that they are buying and they're going to sell on or use in the manufacturing process. So in other words, this could lead to a one-sided currency risk, but we will cover that in more detail later on. So the third point on the page is that when hedging, buyers can actually benefit from a rate that is higher than the current spot rate. I will go into more detail on this in this slide here on point 3. But first off, let's go into the benefits of TRY payments for exporters or suppliers based in Turkey. So the first one is the reduction of currency risk. Since some or most of the cost can actually be in Turkish lira, there is a currency risk due to volatility when receiving payments in currencies that are either in euros or dollars, or if you're paying out of the UK, I guess in GBP. So switching to Turkish lira would actually mitigate that risk. Secondly, the suppliers can be paid quicker because of Ebury's trade finance proposition. Now, just a brief intro on Ebury's trade finance proposition. It is an unsecured facility for our clients where they have to make repayments after 150 days. Now, we are able to offer better conditions on the trade finance side for clients that make payments in TRY or in Turkish lira. The suppliers benefit from this because the buyers' increased liquidity enables them to make payments earlier, which then would automatically reduce the cost of capital of the supplier. The final point, the improved FX rates, ties to the third point on the previous slide. So we are able to offer a hedging rate that is higher than the current spot rate. Therefore, if prices are fixed between the buyer and the supplier, both sides are able to benefit from improved FX rates. Now let's have a quick look at a case study of the Dutch lifestyle brand. So it's a textiles company that sell mainly to retailers in the Netherlands, and their purchasing power lies at around 1.5 million euros, and they purchase everything from Turkey. And prior to Ebury getting in touch with them, there was no FX strategy in place. So down here, we can see a brief timeline of our conversations with this particular client. We first contacted the client in October 2019, and then started the trade finance process months later in the summer of 2020. Shortly after we started that process, we also realized that payments are actually being made to Turkey. And we started discussions on Turkish lira payments. After which the client contacted his supplier, and they came to an agreement that payments are going to be made in liras. We approved the trade finance line in September 2020, and consequently also booked the first forward in TRY. And we've been trading with this client ever since, and we were in discussions to expand the trade finance line over the course of March and April this year. And I'm actually happy to say that this week we came to a happy end, and that is now in place. So to give you a quick overview of the Ebury solution, it was mainly based on Turkish lira payments and trade finance. So we provided the client with a trade finance line, which increased our client's liquidity, and at the same time allowed the Turkish supplier to receive his funds sooner. This provided a cost reduction for our client. And for both sides, it mitigated the currency risk in a highly volatile environment, because we hedged the rate the client and the supplier had agreed upon. Moving on to the parallel forward. Just a brief overview, first of all. We will go into an example shortly. So paying suppliers in Turkish lira instead of euros, for example, has the benefits of achieving stable pricing, and there will be less you will be less affected by the rate fluctuations of Euro TRY or USD TRY. And the parallel forward allows Ebury clients to hedge the TRY risk, but settle with suppliers in euros. So the payments themselves would be made in euros. Now, let's quickly have a look at how this would work in practice. How does the parallel forward benefit both buyers and suppliers? So we've got two separate case studies here. First of all, let's look at the left-hand side of the page, where the prices are fixed in euros. So suppliers may fix the prices in euros, but they will still need to convert the euros that they received on the spot market into TRY for overheads or other operational costs. Now, a brief example, imagine your supplier has a base rate of 900,000 lira, and they use a reference rate of Euro TRY at 9.0, which in turn means they convert the price to 100,000 euros. Now, if Euro TRY rises to 10, the supplier will now receive 1 million lira, which means he earns additional revenues. However, the pricing does not get adjusted, and the buyer, in this case, the European buyer, doesn't see any advantage of it. However, if we look down here, if Euro TRY drops to 8, the supplier actually may increase his prices in euros because he may be risking of losing some of his own profit margins for his invoiced goods. This can happen because local production costs have increased relative to the euro. So as you can see here, if it does drop to 8, there will be a price deficit of 100,000 lira. And the buyer will have to, more likely than not, fund the difference. Now let's look at the right-hand side of the screen. What would happen if a parallel forward were in place? So if prices between suppliers and buyers can be fixed in Turkish lira, with the parallel forward, payments can still be made in euros. The parallel forward itself will protect against Euro TRY risks. So let's continue our example where the base rate of the supplier is at 900,000 lira. The buyer then would hedge his 100,000 euros at the rate of Euro TRY equals 9 for, let's say, 1 year. So the costs for the buyer are fixed at 100,000 euros. Since, in this case, the supplier requested that payments be made in euros, the TRY can be bought on the spot markets and the payment can be sent out to the supplier. Now down here you can see two options. If Euro TRY does increase to 10, the supplier will receive 90,000 euros. Conversely, if it drops to 8, the supplier will receive 112,500 euros. However, since the rate was fixed, this makes no difference to the European buyer. So to summarize it in 1 or 2 sentences, by using Ebury's parallel forward solution, the European buyer can actually eliminate the one-sided TRY risk by fixing the TRY price, but continuing to making payments in euros. And in best case scenario, this actually leads to long-term stable cost management, not just for the buyer, but also the supplier. Now let's have a quick look at our final case study of the day. It's a medical equipment company based in Portugal, and the main clients are hospitals and clinics. Their purchasing power is right around about 600,000 euros per annum. But this client actually just recently switched to Turkish suppliers from Chinese suppliers actually, because of shipping costs increasing due to COVID-19. So for this particular example, just to give you a bit of background, the client already had a euro-dollar forward at 1.15 in place. Ebury's solution in this case that was presented to both the client and the supplier was TRY hedging and payments. So we gave the supplier two options using invoicing in Turkish lira. And we were able to change this depending on supplier asks. So we either make payments in Turkish lira, or we use the parallel forward and make payments in euros. We restructured the existing euro-dollar forwards at 1.15 into two euro-Turkish lira parallel forwards at 8.50 at no additional costs. This resulted in our client eliminating his one-sided currency risk and the supplier still being able to receive euro payments. And that was my part of the presentation. Thank you for listening. I believe we will now be going into a Q&A. Let me just stop sharing my screen. Right. If you have any questions for Matthew or myself, the Q&A box is down at the bottom.
Please feel free to ask any question you might have. I always take it as a good sign when there's no questions, but good to have one or two. If not, I think we might leave it there, Noyan. I always, as I said, take it as a good sign. I take it as we've covered everything that everyone wanted to hear. So I think we'll wrap it up there then if we don't get any questions. Unless you have any final thoughts, Noyan?
No. Yeah, I agree with you. I hope we did cover everything well enough that there were no questions.
Excellent. All right, then. Thank you everyone for joining. We appreciate it. We'll have we usually do these sort of updates sort of every quarter or so, every sort of 2 or 3 months. So we'll be posting on social media closer to the time when we'll do our next one. As I said, probably in around 2 or 3 months' time. So thank you all very much for joining. We appreciate it.
Thank you for joining, everyone.
Thank you. Bye.